I think you'd have to say that we're kind of at the end of a long phase of economic policy that's really the last 20 some years of completely neglecting fiscal discipline. And what's interesting is it didn't matter which president it was. It didn't matter whether it was President George W. Bush or his successors, both Democrats and Republicans. What they all seem to have been able to agree on is that they didn't want to touch the third rail of trying to come to grips with the arithmetic of overspending.
Dr. Charles Calomiris, Henry Kaufman Professor of Financial Institutions Emeritus at Columbia University, and also author of the book, Fragile by Design. It is great to welcome you on this show, Dr. Calomiris. Thank you so much for taking the time to join me.
It's my pleasure, Julia. Feel free to call me Charles.
Okay, that sounds great, Charles. Well, it is a pleasure to have you. And you put out a paper recently with the St. Louis Fed that I think it just was picked up a lot on social media. And I'm so excited just to talk to you about it because I know a lot of folks that I follow are really interested in it. I imagine my audience will be as well. And that was the Fiscal Dominance and the Return of Zero Interest Bank Reserve Requirements. Before we get into the paper, Dr. Calomiris, I would love to just get your big picture, macro view of the economy, where we are today. Take as much time as you need, and then we'll dive into the paper.
Well, where we are right now is could be described either from a short-run perspective or a long-run perspective. I think from a short-run perspective, you'd say we're in a fairly stable situation, some significant risk of a recession, but I guess there's been economists have been surprised to the upside by how resilient the economy has been despite the contractionary monetary policy. So from a short-run perspective, I think you'd say that the economy is doing okay, kind of, below average maybe, but not horrible. From a long-run perspective, which is, I think, by far the more interesting perspective, I think you'd have to say that we're kind of, if you like, at the end of a long phase of economic policy that's really the last 20 some years of completely neglecting fiscal discipline. And what's interesting is it didn't matter which president it was. It didn't matter whether it was President George W. Bush or his successors, both Democrats and Republicans. What they all seem to have been able to agree on is that they didn't want to touch the third rail of trying to come to grips with the arithmetic of overspending. And of course, especially in a divided country, with a divided government between Democrats and Republicans in different houses and in the White House too, that's kind of the path of least resistance, isn't it? Because if people disagree, what they can do to compromise is just agree to keep spending, and I'll give you your spending, you give me mine. But the deeper disappointment has been that since the 1970s, certainly, and even clearly and very publicly since the 1980s, policymakers and economists have been commenting on the need to fix the long-term arithmetic problem of Medicare and Social Security. And that long-term arithmetic has been apparent for really 40 years at least. What it has shown us is that we cannot continue to honor the promises that we've made as a matter of arithmetic. And if we do continue to try to do that, we're going to end up having to force the Federal Reserve to abandon its 2% inflation target and to run basically a banana republic based on a complete lack of control over government expenditure. So I think from the longer term perspective, the state of the economy is dysfunctional, politically dysfunctional, and a prisoner of a kind of dysfunctional political nonchalance, lack of willingness to deal with reality. But what's strange is that this is happening for 40 years. And it's kind of like the frog in the pot story about how, you put the frog in the pot, you heat it up, and it never jumps out. It ends up being boiled to death because it kind of gets used to things the way they are. So we've kind of gotten used to denial politics, to dishonest sort of pretending politics. And the blame, of course, I hope we'll get into this, is ours. When people say to me, well, who's to blame here? I said, look in the mirror, buddy. That's who's to blame. You have decided not to hold politicians accountable for this. Politicians just want to get elected. If you punish them for speaking the truth and you reward them for playing these denial games, that's exactly what they'll do. And that's the explanation. It's particularly surprising because your generation, I can tell you're a lot younger than I am, your generation is the one that's going to bear the brunt of this. My friend Larry Kotlikoff, who's an economics professor at Boston University, has been writing for a long time about generational government accounting and trying to get younger people particularly to understand that this arithmetic, it's like, we're the guys, we older guys are the ones who are kind of stealing everything. And by the time we're dead, we'll probably have all of the promises still honored. But then when it's your time to collect, you're going to find that there's nothing for you to collect. And I think that's really hideous that people are doing that. I'm going to get my one cheap shot in, which is I watch these commercials for the AARP and they make me nauseous. They make me want to vomit because so many old people associate with that organization completely selfishly, not thinking about how much damage it does to our society to have this single issue politics where old people are lobbying so hard to keep the value of their benefits, and they don't care if it's going to bankrupt our society. And the AARP is right at the center of that hypocrisy and just disgusting kind of political lobbying. So I think we have a serious problem in our economy. And why aren't you young people out with torches and pitchforks trying to deal with it? That's what I want to know. That's my question for you.
Well, I would like to know that too, because my assumption is I'm not going to get any. And it is a good point to hold politicians accountable. And, Stanley Druckenmiller, going back at least a decade, he's been calling this entitlement spending generational theft. And I think he's so spot on. It is absolutely mind-blowing.
Well, and he's not alone. It's all responsible adults, whether they're economists or not, understand this issue. There's also an opportunity I want to highlight coming from your comment, Julia, which is your comment is that many people your age don't really believe that they're going to get it. And that's a very interesting fact, because what it also suggests is a wonderful compromise, because a wonderful solution, which is if I were to tell you, well, Julia, suppose I can lock in today through a credible political deal 80% of what you've been promised, you'd probably be relieved. You'd probably think that's a deal worth doing. And tell older people, depending on a sliding scale basis based on their age, well, if you're in your 50s, it's going to be 80%. If you're already in your 60s or 70s, maybe we're going to have to go up to 90, 95%. But we're all going to have to make some sacrifices, and you make a deal. When people have the belief that you described, that's a political opportunity. But what we need is a political leader who can frame this issue and get people to see it and get people to be responsive to it.
And also, people live a lot longer. And I think, when it was probably established, Social Security, people really weren't living as long as they certainly do today. And I kind of wondered, I am definitely not an expert, why not just kind of waterfall it a little bit where you kind of just move the goalpost just a few months for everybody over time, and then it adds up? Because that's what I don't understand. It just seems like there's got to be some sort of a solution.
Well, that's happened already to some extent. For me, I am retiring. I'm not retiring, but even for Social Security benefits, the rules have changed. The goalposts have been moved, as you put it, and it should be done more so. And it should be done in a way that's predictable, so that people who are in their 50s have the goalposts moved less than people your age, and people in their 60s even less than the people in the 50s. So I think that this is the obvious kind of solution. There's also got to be some reduction in benefits and in some of the inflation indexing and some of the other rules that have inflated those benefits in real terms. But again, Medicare is the bigger problem than Social Security. So it's not just a matter of Social Security. It's also a matter of trying to figure out how we do the very difficult thing of getting people to be responsible more for their own healthcare and letting markets discipline healthcare in the same way that they discipline things like food and shelter. I mean, after all, we all need food, and we all need shelter, just like we all need medical care. But we're used to making hard decisions when it comes to food and shelter. And obviously, medical care is a lot harder emotionally and politically, therefore. But that doesn't mean it can't be done. And I think that this is what grown-ups do. We are not a grown-up society right now, which shouldn't come as much of a surprise to you if you look at the two presidential candidates that currently seem to be frontrunners in their respective parties. No grown-up society would have either one of them. Sorry to be to comment on political things, but I do think that it's a wonderful sort of reflection of the unreality of our society, who we have as our prospective leaders. That just shows how dysfunctional we are, that we're not expecting more of ourselves. That's the problem. Problem is somehow we've been trained to just, not focus on reality. I don't get it.
Yeah. Well, there are no rules on this show, Dr. Calomiris. You could talk as long as you want, and you can bring up whatever topic that you want. We don't have those kinds of constraints. But as we are recording this episode, I did check the U.S. debt clock, and we are ticking higher. We're at 33.9 trillion. I mean, that number could, I don't know, maybe it'll cross 34 trillion by the end of the year or when this episode runs. So my question for you is, at what point do you think, when you look at the arithmetic, do we reach the constraint here?
It's a great question. So the way economists look at this is they work backwards from things that they are confident about. And then they try to working backwards from things that they're confident about as a matter of arithmetic. They then formulate an opinion about thresholds where you trigger something or trip a barrier. So let's work backwards. We can't have a debt to GDP ratio of infinity. So that's a really useful thing to start with. We can all kind of agree that if it's going to infinity, that's not sustainable. If that ratio of debt to GDP is going to infinity. So then notice, let me remind you a little bit of your junior high school math. In a ratio, if the numerator is growing faster than the denominator, where does that end up? It ends up in infinity. So let's start, just to make it really clear, let's start with where the GDP is right now. It's at roughly, both in a market value sense, it's a little lower, but in a face value sense, it's about 100% of GDP. So let's just work with that number. Let's say that we're at about 100% of GDP. That means the ratio is currently 1, right? The debt to GDP. And so if the GDP grows at, let's say, 1.5% in real terms, then what happens if the debt grows at more than 1.5% in real terms? So with a 2% inflation target, that means that the debt can't grow more than about 3.5% a year. So we know that if the debt's growing at 3.5% a year, we're going to be at more than 3.5% a year. Then the debt to GDP ratio goes off to infinity, and that's not feasible. And so notice that we're already in a situation where the projected deficits that are hardwired in the system based on commitments of entitlements take us to about a 6%, not a 3.5%, but a 6% growth. So just, you could say, well, people should already be panicking, right? The bond vigilantes should already be coming out because it's already clear that we lack the political will to reverse that situation. You could say that. And so if the bond vigilantes came out right now, you'd have a lot of professors saying, I told you so, that would say, well, see, the bond vigilantes finally came to the conclusion that the U.S. wasn't going to reverse its commitments, and therefore that we're in already an inflation debt crisis. And you would then see auctions of U.S. Treasuries failing. You'd see the Fed having to change its policies to buy U.S. Treasuries massively. And you'd see the beginning of the inflation and also what I, in my article, describe as the likely destruction of the banking system. So the answer then is the bond market still has hope that that scenario of the excessive deficits would somehow be reversed. And so that's why your question is a difficult question to answer, because we already know that based on our commitments, we're already at a point beyond return. What we have to believe then is a political calculation of whether those permanent commitments will be reversed by a major change in policy. And you could say that just observing the fact that the bond market is not panicking is telling you that somehow people are still holding out in the hope or belief that there will be a political decision. So here's the difficult thing for an economist to say to you, Julia. Economists aren't great political forecasters. If you told me that everyone agreed that we would not change our long-term commitments, then I would say that my economic prediction would be we'd have a panic in the bond market immediately. But given that that's not the case, I'm inferring that some people, at least a sufficient number, are holding out some hope that sometime over the next, let's say, 5 years, that we are going to take this issue on and fix it. And that's why the bond market hasn't already panicked, because we're already beyond the point of no return if we keep all the promises we've made. So that's where it gets tricky for us to say, as economists, when does the panic happen? But once that panic happens, it has a life of its own, because once the bond markets take the inflation risk seriously, that increases the interest rate due on government debt, and it makes the problem, pretty much non-solvable. So once the bond markets become convinced that we're at a point beyond return politically, then the interest rates will start to rise, making the problem worse and making it very likely that we won't be able to solve it. So I think one of the problems here is that at some point when the frog is in the water and it heats up gradually, the frog does die. And so we don't have forever. I would say, if you ask me how long do I think we have, and this is just based on guesswork because it's a political forecast, I would say that we have something less than a decade to make that political decision. And by the way, the Treasury Department agrees with me in the sense that its own forecasts, its own statement is that the debt path is unsustainable. That's a matter of U.S. government statement by signed by the Secretary of the Treasury, and also pointing out that the path of debt to GDP is going to rise very rapidly over the next couple decades. So I think that's kind of where we are, that your generation has about a decade left to figure this out.
Hey there, I just want to quickly interrupt the video and just say thank you. Thank you so much for coming to this channel and choosing to watch this interview. I hope that you are enjoying it, and I appreciate you visiting the channel. If you like what you see, please hit that subscribe button. It doesn't cost anything. It's totally free, and it will keep you up to date on all of my interviews. I post 2 interviews a week with some of the most incredible people in finance and investing, and your support will help me bring in some more amazing guests. If you already are one of my subscribers, thank you so much. I cannot express to you how much your support means to me. I am incredibly grateful that I get to do something that I'm truly passionate about, and you being there week after week, it not only gives me that energy, but it just gives me that faith to keep going, and it means everything to me. And I love seeing you all in the comments section. I love interacting with you. I love interacting with you on email or social media. I just love hearing from you all. And I just appreciate your support so much. I feel incredibly lucky that I get to do something that I just love. So I just want to say thank you and appreciate you subscribing. All right, back to the interview. There's so many questions I want to explore a little bit further with you. And as you point out, the bond market right now, it still has hope. But my thought or my question here is that false hope? Because when you look at the deficits, and as you point out, a lot of them are hardwired, and also just the deficit spending. And right now, we're in an okay economic environment, as you put it, like the third quarter GDP print, I think it was 5.2%. So things are like good right now. So what happens when things aren't so good? We get more in a recessionary environment with the deficit. Does that just increase?
Obviously, that makes it worse. But I really want to emphasize that the cyclical changes relating to the deficit are dwarfed in importance by the long-term commitment. So if the problem we had to deal with is our current debt to GDP ratio and cyclical movements, the bond market would keep the faith. The bond market, which is so important, what faith it has, would keep the faith and say, well, this is a cyclical problem. There's no reason to get too excited about it. The problem is we're already at a debt to GDP ratio that we've only seen in the World War II kind of environment. And this reflects the lack of willingness to address the problem. It's not a cyclical problem, and if the cyclical deficit went up, I don't think that would particularly worry the bond market because they would, with good reason, see that as a short-term problem that would be reversed by good times that would likely follow the recession. So recessions tend to be brief, recoveries tend to be longer, but I think that, it's really not the cyclical problem that's keeping us all up at night. It's the longer-term arithmetic problem and the already demonstrated lack of political will to deal with it. I mean, if you knew that your way of dealing with problems had been something that politicians, by ignoring this arithmetic, have been able to get reelected and have been able to get away with having voters vote for them. That's the most depressing thing because the voters don't seem to be rewarding it. And that's what makes one think this is not likely to reverse. I'm a little bit encouraged by the fact that Nikki Haley, who was really, in my mind, the first one to bring this issue up this year and hold others to account on it, I'm encouraged that she had the courage to do it and that she hasn't suffered negative consequences for doing it. But she's still a long shot, but it does tell us something good that she's willing to have that conversation. That's something new.
Mm-hmm. Yes. Okay, so I want to have another follow-on. When the bond market does recognize or becomes convinced that we are beyond the point of no return, how do you start to recognize that, or what are the signs of that?
Interest rates go up because before, so we, just to use a little technical analysis language, the interest rate on, let's say, U.S. Treasuries, the interest rate or yield to maturity, that's the same thing as the interest rate. The yield to maturity, the return that you get in nominal terms from holding it, let's say might be 5% for a certain maturity Treasury bond right now. For long-term Treasuries, it would be 5%. Now, if people start seeing that there's a big risk that you're going to lose the ability to maintain the long-term inflation target of 2%, if they see that, that means that the yield will go up, and it will call that initial increase in the yield before we actually lose control and start inflating. We'll call that an inflation risk premium, that the market will say, oh, the yield's going up because of inflation risk. And then once the inflation happens, the yield will stay high because of the inflation premium once the risk has been realized. So the first sign will be that when you see the real return, that is the difference between the yield to maturity on government debt and the current inflation rate, when you see that getting very high, that will tell you that people are seeing a big risk of a jump in inflation in the near future.
I do want to bring up, Dr. Calomiris, your paper, Fiscal Dominance and the Return of Zero Interest bank reserve requirements. And I will link this in the show notes for the folks who are watching and listening, and I encourage you all to read it. Can we just start, Dr. Calomiris, with the concept of fiscal dominance and, kind of defining what that is?
So we've already discussed that there's going to come a point where the bond market comes to the conclusion that fiscal policy, that is spending and taxing, that the fiscal policy deficits and accumulated deficits, which have led to a debt to GDP ratio, is no longer sustainable. When that happens, fiscal arithmetic dominates monetary policy. That's why it's called fiscal dominance, because what it means is that the Federal Reserve, once the market is convinced that it's no longer sustainable for the government to issue such a large amounts of debt into the private sector to be held in as real stores of value, then what has to replace that is the Federal Reserve has to step in and buy that debt. And what that means is the Federal Reserve will have to put aside its own inflation target, long-term inflation target of 2%, because you can't serve two masters. So fiscal dominance means the Federal Reserve steps in to buy the government debt, therefore increasing the money supply, because that's what the money supply is. It's the liabilities of the Federal Reserve. So when the Federal Reserve buys government debt, that's assets on the Fed's balance sheet. It creates liabilities, writes checks on itself effectively to buy those assets. So that's what fiscal dominance means. It means that the Federal Reserve has to give up on its own independent monetary policy of a 2% inflation target and take on its role of lender of last resort to the US government, abandoning its 2% inflation target. And then the question is, well, once we have that fiscal dominance situation, under the current unsustainable promises for Medicare, Social Security, and defense policy combined, those are the three big categories, under the current unsustainable promises, how big will that inflation get? Once fiscal dominance replaces inflation targeting by the Fed as the determinant of inflation, once fiscal dominance is driving the bus, how high is that inflation rate going to be? And I tried in my paper to give a sense of how there's a range of answers to that depending on another political calculation, which is, will the government be willing to keep the inflation rate lower than it would otherwise be by effectively taxing the banking system into almost oblivion? And my own judgment as an economic historian who's looked at this policy for a long time is that the government will likely do that. And so my prediction is not just that the arithmetic will ultimately lead to fiscal dominance and a much higher inflation rate, but that further, the political calculation leads me to think that the government will decide to effectively tax the banking system to try to limit the size of the inflation rate that will come from the new fiscal dominant situation. Now, that was a lot to swallow, Julia. I hope that it was clear.
It is clear, and it's so great to have you. A couple of things I want to just pull on again. Let's explore this notion, this idea that one of the likely outcomes here is taxing the banking system. Walk us through how that might play out.
Okay, so there are a couple of steps to this. It's a little complicated, so please bear with me. The first thing I want to establish in everyone's mind is the idea of a tax base. So we all know that the tax base for the income tax is the income that Americans earn, right?
Right.
So that if you were going to say how much income tax does the government get, it would be the tax rate that we're subject to multiplied by the income that we made that's taxable. And so the total tax revenues to the government reflect a multiplication of a tax rate and a tax base. Is that clear so far?
That's clear. Mm-hmm.
Okay. So with inflation, the way that inflation works to balance the books. So when we say that we are in a fiscal dominance situation, the arithmetic then says, well, the way the books have to be balanced is we have to increase the rate of inflation. But you shouldn't take that for granted as so obvious. You should ask, well, how exactly does that restore the balance to the arithmetic? And the answer is that something happens called the inflation tax. And the inflation tax is what balances things so that the out of control spending comes into balance, because you get a new kind of tax called the inflation tax. To give you a simple sense of the inflation tax today, the inflation tax is currently entirely a tax on cash outstanding. That is, do you have any cash in your pocket? I'm trying to see if I have any. I don't. But that's what I'm talking about. When I say a tax on cash entirely, what I mean is only the cash in your pocket and in the pockets of others all over the world. Why is that? Because when inflation goes up, the money you have in your pocket loses purchasing power at a constant rate, doesn't it?
Mm-hmm. Wait.
If you're holding a $100 bill in your pocket and and price inflation just over the course of today, let's say that prices are inflated 1%. Well, that means you lost
my purchasing power goes down.
$1 of purchasing power because you were holding $100 in your pocket. Today, inflation is just 1% per day. So you lose $1 of purchasing power on that $100 bill in your pocket, right?
Right.
That's how inflation taxation works. But inflation taxation, which is the product of the inflation rate and the inflation tax base, just like any other tax. But the key thing is that right now, the only part of the inflation tax base is the cash held by people. And the reason for that is that about a decade ago, the U.S. departed from longstanding tradition and decided to pay interest on reserves and pay them at the market rate, and it has often been above the market rate. So what that means is there is currently, under current policy, banks earn interest on reserves at the Fed. The only Federal Reserve liability that doesn't pay interest is cash. And that's why that's the tax base, because you can't make profit as a government from an inflation tax on the things that you pay interest on. So reserves are effectively part of the consolidated government debt. The reserves the banks hold are just like treasury bills issued by the federal government. There's no substantive difference from an inflation tax-based standpoint. Since reserves pay interest, when inflation goes up, the interest rate paid on reserves goes up commensurately. So there's no tax on banks holding reserves under current law because reserves are paying the market rate. Just like there's no tax on bondholders if they're holding, let's say, treasury bills and interest rates go up and they're anticipating that this inflation problem, as long as they're anticipating interest rates go up, then they don't get taxed because the interest rate goes up 1-for-1 with the rate of inflation. Now, what that tells us is that the inflation tax base currently is entirely cash. Didn't used to be. 20 years ago, it wasn't. 30 years ago, it wasn't. 40 years ago, it wasn't. But today, it's exclusively cash. And that's a very small amount. So my paper shows that if the government had to finance through fiscal dominance these unsustainable promises for Medicare, Social Security, and national defense, if it had to fund those, and it had to do that with the inflation tax, with only cash as the inflation tax base, if you do the arithmetic, that leads you to expect something like 35 or 40% annual inflation, maybe even higher.
Wait, sorry, can you repeat that one more time, the numbers?
Yes. If we had no change in policy so that the only inflation tax base were cash, then to fund the current deficits you'd have to collect inflation tax revenues equal to the inflation rate multiplied by those cash outstanding balances that we're all holding. So that's how you figure out what the implied inflation rate would have to be. And so in the arithmetic in my paper, I showed that number, if the inflation tax base were only just the outstanding cash, that inflation rate that would balance things to make the arithmetic work would have to be a number that's very high, 35, 40%, maybe even higher. So the annual inflation rate in the US economy would start looking like a banana republic because we're running policies of a banana republic. But there is an alternative, Julia. You might say, unfortunately, for the banks, there's an alternative, which is the government could come back and say, well, we're going to make banks hold a very large percentage of their deposits. Their deposits are liabilities of the bank. You, I'm sure, just like me, have deposits at a bank. And we earn interest on those deposits. And the reason the bank can afford to pay us interest on those deposits is the bank can invest those deposits in loans and also in government securities that pay interest, and also in reserves at the Fed that pay interest. But what if the Federal Reserve said, well, we happen to have a very handy victim called the banking system. And we're going to tell the banks, as a proportion of your deposits, let's say 30%, which is a very high number for the US historically, but it's not an outrageously high number if you look at history and at banana republics. We're going to require you to hold 30% of your deposits in reserves at the Federal Reserve paying zero interest, which is what we used to do. We used to require some holding, not 30% of your deposits, but some percentage, maybe 10%, is not that far in the past, at zero interest. So we're going to require you to do that. I want to notice, why is this something that politically could happen? It can happen because the Federal Reserve, that will have its back to the wall when the bond market decides that it doesn't want to hold any more real government debt, it will have to be the lender of last resort to the government. And the interesting news is the Federal Reserve is also placed with all the authority to decide the reserve requirements of the banks and the interest to pay on them. So without having to pass any laws or having any political debate, the Federal Reserve, once the bond vigilantes clamp down on the government, and the Fed has to, through fiscal dominance, be the purchaser of last resort of government debt, the Fed could decide to raise reserve requirements from zero, which is what they are right now, as a percentage of deposits, to a very large number, like let's say 30%. And it could also decide to pay zero interest on the deposits instead of paying the market rate. Why would the Federal Reserve do that? Because doing that would expand the inflation tax base dramatically. Because the inflation tax base are liabilities of the Federal Reserve that are not paying interest. That's what's true of the cash in your pocket. But the Fed could decide to expand that inflation tax base to also include reserves held by the banks and to require them to hold a large amount of such reserves. What would be the advantage of doing that? By expanding the inflation tax base, you could reduce the implied rate of inflation dramatically. That would still be consistent with the product of the inflation rate and the tax base, inflation tax base, being enough to sustain the ongoing deficits. And so I calculate, and again, these are rough calculations, but they make the point that probably they could, by doing that, reduce the inflation rate to something like 10%. So instead of an inflation rate of 30 or 40%, if the Fed decided to impose that burden on the banks, that would lower the inflation rate to maybe a number like 10%. Again, these are not exact calculations.
Right.
And so I notice that the Fed would have the political ability to do that, that the government, the president in particular, and the Secretary of the Treasury would put a lot of pressure on the Fed because that would be very popular from the standpoint of the election, to make the inflation rate not 40%, but to make it 10%. But what would be the consequence of this? That effectively the banking system would be paying a huge new tax that would make the banking system non-competitive with financial markets or other countries' banking systems. And so it would trash the banking system. And so the point of my paper is to say, if you do a little bit of arithmetic combined with some political forecasting, what you end up believing is we aren't going to fix our problem because we've chosen to ignore it so far for 40 years. And when we finally get hit by the crisis, the path of least resistance politically will be for the Fed to use its power to increase reserve requirements and to not pay interest on those reserves, to reduce the implied inflation rate from a number like 40% to a number like 10%. And so that's a political and arithmetic calculation combined. I hope that was clear.
This is fascinating, and you're making it very clear. Okay, I do have a follow-on for you. Just thinking about this, because I imagine, okay, the banks obviously will not like this, but there's probably very little sympathy for the banks, maybe in the way I don't know. But I imagine, okay, it hits their profitability, but it trashes the financial system. But I imagine too, like that could have some consequences that could be more ripple effects across the broader economy. How do you kind of think about that or extrapolate that for us?
Well, let me point out, first of all, that when the banks get hit with this, the bank stockholders are not the only ones who will suffer. The main tax will be passed through to the depositors in the form of lower interest on their deposits. Now, the last time this happened, in the 1970s in the US, what did those depositors do? They started looking for alternatives because deposit interest rates, through a combination of inflation and other regulations on banks, were very low while inflation kept rising. So what happened was we created the commercial paper market. We created money market mutual funds. We created credit unions. All of those grew because they were relatively advantaged. So one obvious prediction is the banking system will shrink in importance over time. But of course, it can't shrink too much, or else the government's going to then have to look for alternative ways to raise the inflation tax that it needs. So the first prediction is the banking system will shrink. Does that make sense?
That makes sense.
Okay, now when the banking system shrinks, that means there's less credit to the economy coming from the banking system, which is going to be a negative for the economy. But depositors will be looking to find new ways to invest their funds outside the banking system. And then those funds, through financial markets or money market mutual funds or other things, will find their way back into what we sometimes call the shadow banking system. That is, financial intermediaries that aren't subject to these reserve requirements. And so one obvious prediction, which is what happened in the 70s, is when the government tries to use the banking system as a form of inflation tax, then we see the banking system shrinking, and we see, while there's a temporary negative on credit available for companies, eventually, as depositors move their funds to other sources, that's mitigated, not eliminated, but mitigated. So, but then this is a problem for us. It's not the 1970s anymore. What does the government do if depositors start to move their funds to other sources? The government has to pay these bills coming from Medicare, Social Security, and national defense. So what I would say is it's likely longer term, like now we're talking maybe 5 to 10 years after the collapse of the bond market that we've already discussed and the fiscal dominance situation, the government's going to have to probably expand the reserve tax, that is the reserve requirement, beyond the traditional banking system, and find a way, because that's the only way to make the arithmetic work, to effectively require other intermediaries to hold zero interest Federal Reserve reserves. You know, back in 1980, a University of Chicago professor, who's still a professor there, I think, Eugene Fama, a very famous financial economist, wrote a famous article actually pointing out that you could imagine doing this for the whole economy, that one way to for the government's balance books to balance would be for the government to require every company, not just banks and financial institutions, but every company to hold some zero interest cash issued by the Fed as a proportion of its liabilities or a proportion of its assets, proportion of its profits, however you want to do it. But the point is, the Federal Reserve, if Congress didn't prevent that, if Congress empowered the Federal Reserve, that would be one way to solve the problem, just creating an inflation tax that would apply to the whole economy. Now, I'm not saying that that's likely to happen, but I'm just pointing out that it's not a coincidence that in 1980, after this very high rate of inflation episode we had in the 60s and the 70s, that people were thinking, when I went to graduate school, this is what we were all thinking about, is how would you deal with this problem? And now we're confronting it. Mm-hmm. And so as the inflation tax base shrinks through the shrinkage of the banking system, as a result of the policies that I have already predicted would happen, that is, the Fed would decide to impose a high reserve requirement, maybe 20 or 30% at least of deposits paying zero interest, banking system would shrink, the shadow banking system would grow, but then the Fed would need a new source of revenue for the inflation tax. And so it would likely be empowered by Congress to expand reserve requirements. Or at that point, maybe we'd all be so angry about high inflation, now inflation of, let's say, 15% or something like that, that we'd fix our long-term problem coming from Medicare, Social Security, and defense. Of course, that is, I think, a very likely outcome.
Right.
When inflation rises and is very unpopular, then the issue that people have been ignoring having to do with government spending often gets addressed. That's a typical lesson from history, even in banana republics. Remember, Argentina and Brazil had inflation rates in the thousands of percent in the 1970s and 1980s, which led to major reforms that those countries adopted in the early 1990s. So I'm just saying, I think that there we could have a lot of different scenarios about what happens, but I think what we can say reasonably is, first thing that's going to happen is the Fed is going to tax the banking system. The banking system is going to shrink, and then we're going to have to either expand Fed taxation beyond the banking system to other shadow banks, or solve the problem another way by reducing expenditures and increasing direct taxes, that is, income tax, for example. I hope that response was clear.
Yes. One of my follow-on questions to this is, what could this potentially mean? I don't know if you have a view here, but it sounds like, so is this what you would call, before I ask my question, is this what you would also call monetary inflation?
Well,
not like
all inflation is monetary.
Okay.
I mean, it's coming from the Federal Reserve, effectively what we like to call printing money. But, it's not a printing press. The Federal Reserve, what it means to cause inflation by printing money is the Federal Reserve forces, effectively, in the scenario I'm outlining, forces banks or other institutions potentially to hold its liabilities at zero interest. I mean, think about it, Julia. You would love this power, wouldn't you? Wouldn't you love the power to tell me right now, especially since I was teasing you earlier, to tell me I have to hold a Julia IOU with zero interest for an indeterminate period of time? Because that's the same as my giving you the money, isn't it?
I don't know if I would enjoy that.
Well, God bless you. I appreciate that. But I think you can see that it's quite a power to be the monetary authority, because you are the one, by virtue of this monetary monopoly, you are the one who's got the right to issue zero interest IOUs and force institutions like banks to hold them as a proportion of whatever you like. And so it's a pretty awesome power. And I use the word in the traditional meaning of awesome, not the current usage. It is an awesome power. It is a power that is every bit as great as the power of the state to tax your income. And the Federal Reserve possesses that power.
And they weren't even
luckily,
elected, though.
for me,
They
don't.
weren't elected, which is kind of wild.
Well, they weren't elected. They were appointed.
Yeah.
You could argue that the Federal Reserve is unconstitutional. Some people have made that argument. But we are way beyond these powers to create the Fed. When it was created, let me remind you, it was created under a gold standard. So when the Fed was initially given these powers, the Fed was constrained to not be able to run its own inflation tax by its constraint to adhere to the gold standard. But what happened over time in the 1930s, as we left the gold standard, the Fed got increasing power, not just because of its regulatory powers, but also because we were no longer on the gold standard, which allowed the Fed to take its power to determine reserve requirements, and now the interest rate on reserves too, to take that power and to turn it into an inflation tax power. So when the Fed was originally created, this was not envisioned. This came about as a result of the decision to leave the gold standard combined in the 1930s, combined with the prior decision to create the Federal Reserve. So you could say we kind of backed into this problem.
Let me ask you this too. I don't know if this is an area that you think about or cover, but this came up as a topic recently on the show.
Yes.
I had one of the investors on my show, Michael Howell, was talking about gold and Bitcoin as monetary inflation hedges. Do you have viewpoints on something like Bitcoin in this kind of scenario?
Well, I do have viewpoints on Bitcoin. So this could, maybe we'll have a longer conversation where I can flesh this out for you more fully because it's a long conversation. So as an economist, you have to ask yourself two questions about Bitcoin. Because we have to understand it as an asset before we can talk about it as a hedge, right? We have to understand how it's valued as an asset before we can say whether it's a hedge against inflation. Gold is a hedge against inflation. If all this doomsday scenario stuff that I've been talking about happens, gold will preserve its value relative to other things, which is why buying gold now is a hedge against this set of events I was just describing. And in fact, I would venture to say that part of the near-term increase in gold prices that we've witnessed reflects the fact that people are starting to see this as a global risk, not just the U.S. risk. Other countries are following the same risk that the U.S. is. But what about Bitcoin? So to figure out whether Bitcoin is a hedge, so all real assets, stocks are a hedge against inflation too. All real assets are a hedge against inflation. So if Bitcoin's a real asset, it's also a hedge against inflation. And if it's a liquid real asset like gold that can be traded very easily, then so much more. The problem with Bitcoin is, as economists, we have to ask two questions about Bitcoin. First of all, why does it currently have any value at all? How did it came to be valued? And we have pretty good economic models that can explain that. But those same economic models lead me to believe that the long-term value of Bitcoin is zero. Because Bitcoin's value as an exchange mechanism, a store of value, was entirely the result of its first mover status. There is no fundamental backing to it. It's an inferior technology from several perspectives relative to easily available alternatives, that is stable coins. So from a store of value or medium of exchange, exchanges through blockchain can happen. Bitcoin is a limited network. It can't expand much beyond what it already is in terms of being able to do transactions. So Bitcoin has no real value, is very volatile in its value, and has limited capacity to actually execute exchanges. So Bitcoin's an inferior technology, which has value today only for one reason, because it was the first mover initially. Bitcoin will eventually go to zero as it's replaced by other blockchain credible stable coins, which are the obvious technology of the future, because when that blockchain network is fully developed, it will not have the capacity limits of Bitcoin to as a transaction technology, and it will have no volatility in its price, and it will be able to therefore be able to execute things much better. It'll have some other advantages, which will be the ability to combine other messaging through the blockchain with the transfer of purchasing power. So the future of exchange is very much, in my opinion, going to be stable coins. They will be looking a little different from the ones that you're experiencing today, but I think that's very much the future. That's a bad news scenario for Bitcoin. So my view is Bitcoin might, in the short term, still survive as an asset. It's very volatile. I don't own any Bitcoin. I've never been interested in buying it. And certainly it's not a good medium of exchange because of that volatility and because its long-run value will go to zero.
Got it. Well, I have to say, Dr. Calomiris, I've so enjoyed having you on. I want to give you a few minutes for some parting thoughts. And what I'm thinking about is you interact with a lot of young people as a professor, and I'm not young anymore. I'm a millennial. But if you had to leave some parting thoughts for all of this to sum up the conversation, the scenario you laid out for the younger generation, what would you say? What would be your parting message? And also, if you want to plug anything, let folks know where they can, find your work, read your papers, your book, and whatnot. Please take a moment to do so.
Well, I don't have any special access to my work. You just look me up on Google Scholar or wherever, and you'll see all the things I write. My advice to you millennials and others, Gen, whatever the letter is.
Gen Z.
Right,
yeah.
Gen X's or Y's or Z's or whoever. My advice to you is take advantage of this new technology that you have in social media to try to build some kind of a very quickly, because you really only, you don't have a reliable length of time to do this. I would say it could be 5 years away that this catastrophe could be happening. Could be 10. It's not much more than that. And as I say, it could be 5. So this is the moment for you to build your own network of people to educate yourselves and to actually agree to hold politicians to account for this. And so I think, I mentioned Larry Kotlikoff. He tried to start a political party in the U.S. that would help educate people on this. And I think that that's the kind of activity that we need right now. And seems like a good time for a lot of reasons to start a third political party in the United States based on what I would call less divisive, more intelligent kind of thinking. So I hope that would happen. And, you've got this new technology, social media. And so why not use it for something useful instead of the inane things that it's used for all the time?
Well, Dr. Charles Calomiris, you've given us so much to think about. And I just want to thank you again for being so generous with your time, your ideas, all of your wisdom. I really appreciate you taking the time, and I hope to have you back on the show again. Thank you, Dr. Calomiris.
It's my pleasure, Julia. Thanks for the great questions and for the opportunity to talk.